You're listening to Capital Topics, episode number 49. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll share insights from Professor Ken French, a well-known thought leader in academic finance, about 5 things he knows about investing. Enjoy! Good morning, James.
Good morning, François.
How are you?
I'm very good, and how are you?
I'm good, thank you. Okay, so let's jump in. The ideas for today's podcast goes back to last fall when I attended a Dimensional Funds Advanced Conference in Santa Monica, California. These conferences, which are held annually, showcase presentations from dimensional thought leaders and external experts on a range of topics, including the economy, the markets, the latest on financial economic research, and business strategy best practice. One of the regular speakers at these conferences over the years, the renowned Professor of Finance Ken French, also presented again this year.
Yes, well, François, some of our listeners may not know who Ken French is, but he is a giant in academic financial economics. He is the Roth Family Distinguished Professor of Finance at the Tuck School of Business, which is at Dartmouth College in Hanover, New Hampshire. He's mainly recognized for his work on asset pricing and portfolio management in collaboration with Eugene Fama, a Nobel Prize winner in economics in 2013. In an academic paper published in 1992, the co-authors developed the 3-factor statistical model to describe stock returns. It is one of the most cited academic papers in the field. This research is now known as the Fama-French 3-factor model. So in this paper, they demonstrated that a portfolio's return is mainly explained by 3 factors. Number 1, the market's excess return over the risk-free rate. That is, the market's risky, so it's got to give us a return higher than the risk-free asset. Secondly, returns come from the size of firms, that is, large companies versus small companies. And thirdly, it comes from book-to-market values. And what that really means is that you've got value companies versus growth companies. So simply stated, the Fama-French 3-factor model says that over the long term, small-cap stocks outperform large-cap stocks, and value stocks beat growth stocks. And finally, that investors should be compensated for being invested in stock markets over and above the risk-free rate of return.
Yeah, that's a great summary, James. I would also add that Professor French is a board member at Dimensional Funds, where he also works as a consultant and acts as the head of investment policy. We can also state that his research, along with Eugene Fama's research in collaboration with Dimensional, is a core component of our investment philosophy and instrumental in the way we build portfolios and manage portfolios at PWL Capital. Over the years, I've seen a lot of presentations from Professor Ken French, but what I really liked the most about this year's presentation is that he kept his message very simple. His talk focused on 5 concepts that are the fruit of being over 40 years at the leading edge of academic financial economics research. He also produced an essay on this topic titled 5 Things I Know About Investing. As usual, we'll share the link to his essay with our listeners. Now let's jump in. We'll cover each of Ken French's 5 investment concepts and share with our listener our thoughts on each one.
Okay, François, so the first of Ken French's concepts is risk is uncertainty about lifetime consumption. So again, this may sound very mundane, but it's actually really, really brilliant. You know why? Well, the definition of risk is surprisingly a hotly debated topic in finance. Ken French affirms in his essay that there is still a lot of confusion about risk. For me, we've been debating the definition ever since I've been in the wealth management industry over 25 years. And Ken French, goes on to write, and I'm going to quote him, so it's a fairly long quote. When I ask students, he says, investors and friends, what risk means, I get conflicting answers. Some say it is the potential for loss. Others suggest it's the volatility of the return. And others say it's beta from the CAPM. And again, those who studied finance know what CAPM, but for most people, it's just jargon. Good portfolio design, Ken French goes on to say, requires a clear understanding of risk. I define risk as uncertainty about lifetime consumption, broadly defined. People invest because they want to use their wealth in the future. Some might plan to spend all the money on themselves for things like food, shelter, travel, recreation, and medical care. Others may plan to spend some of their wealth on political contributions. Again, that's a bit of an American angle, I guess.
Mm-hmm.
Charitable donations, or gifts and bequests to their children. So to end his quote, Ken French says, "My definition of lifetime consumption includes all of these and any other anticipated uses of wealth." So again, this definition really applies to private client retail investors, not necessarily institutional or hedge fund managers.
Yeah, that's a great quote. But why is this definition so powerful? To me, his definition of risk is deceptively simple, but it gets to the core of how individual investors should look at risk. In my experience, there are three fundamental concerns that are top of mind with all investors when thinking about long-term about their finance, and all three relate to uncertainty about lifetime consumption. One, I want to be able to retire. Two, I need to take care of the basics. Three, money provides financial security.
Okay, well, those three thoughts that all investors have, or three goals, or three concerns, they're critical, and they're on all individual investors' minds. So you're absolutely right, François. So to define risk as uncertainty about lifetime consumption puts the emphasis on the investor and their most important goals. And I think this mindset really will function as an emotional anchor for any investor and influence their investment decision. And so us as advisors, we really should make sure that we grasp for each and every one of our clients how they feel about those three questions. So that, again, at the end of the day, the result should be better long-term investment outcomes. That is to say, you reduce the uncertainty about your ability to have money to pay for the basics. And that's really financial security, and that's all about living off your money in retirement. So again, Ken French states that the general takeaway here is to think about risk holistically. How will a potential investment vary with your existing portfolio and with other sources and uses of wealth? More succinctly, how will it affect the uncertainty about your lifetime consumption?
Okay, now the next concept that Professor French uses in his top-down approach to designing his portfolio is the average dollar invested holds the market. What this means, and I quote him, all investors must collectively hold the global market portfolio of all stocks, all bonds, and other financial assets. Simple arithmetic then says the average dollar invested holds the global market portfolio.
So again, that's very technical, François, but if I interpret this correctly, it means that today, with all the investment vehicles and all the technology available, all investors are playing in the same sandbox.
Exactly, and obviously he goes on by explaining that because the wealth of each is different, that the weight of his or your personal investment wealth in the global market portfolio will be different from another investor. To illustrate this, he gives the example of Bill Gates having a bigger piece of the global market portfolio than he does or that I do. This said, the question is, should we all hold our individual proportionate share of the global market portfolio? The answer to this question is no, and I quote him, "My pro rata slice of the global market portfolio would probably be a fine choice for my portfolio if my preferences and my circumstances matched those of the global average investor."
So again, in his top-down approach to portfolio design, that's where it all starts with him, with his preferences and his circumstances, and that's where it should start with all investors. There's no one size fits all. Everybody should own the global average portfolio.
Exactly. Looking at my personal situation, well, I live in Canada. I spend Canadian dollars for my living expenses, and there are tax consequences to investing in other countries. Therefore, what French says is that I should overweight my home country, and that as a group, domestic market investors tend to overweight their home country as well.
Well, François, home country bias has been studied extensively and exists for many reasons. We addressed the issue of diversification in our podcast last year on the Credit Suisse annual report on global asset classes. Yep. And for an American, global diversification is not as obvious anymore in the last 30 or so, 40 years. So he can take that position. But, again, it'll be a great topic for a future podcast, the home bias. As an indication, though, here for us as Canadian investors, although Canada's global market cap weight is only 3%, most Canadians have a much larger weight in their portfolios to Canadian equities. The latest data I've seen on the topic showed that Canadians had roughly about 60% of their equity position in Canadian stocks. And in our client portfolios, though, I'd like to highlight, we've been allocated to Canada about 20% to Canadian equities, and that's for 20 years now.
Yeah, we're at 20%. We feel it's prudent due to the lack of diversification in the Canadian stock market and to the fact that most of our clients have large U.S. cash flow expenses requirements. Other factors French cites as reasons that your portfolio should differ from the global market portfolio are 1, age or time horizon, 2, your risk aversion, 3, your personal financial circumstances, 4, transaction costs, 5, tax considerations, and 6, other environmental, social, and governance concerns you may have.
Well, again, I think what this really speaks to, François, is that this is where an advisor can add a lot of value for most investors when looking at all those factors and help to guide them in their decision making and sort of to weigh which one is more important so that at the end of the day, they get a portfolio that fits them.
Absolutely. And an advisor can help. But what I understand from my years of experience and to the point of Professor French is making is that there is no ideal portfolio that can take into consideration the multitude of factors at play for each personal situation.
So now we can tackle the third concept that Ken French introduces as part of his what he's learned about investing. Chance dominates realized returns. So let's unbundle that one, okay? He believes you can split an asset's return into its expected return. Now, as I mentioned, we're going to have an upcoming podcast on expected returns. It's our research group develops a paper and updates it every year, sometimes twice, like last year, where we talk what are stocks going to generate, what are bonds, and what are different combinations of portfolios. Well, these expected returns really is our best guess of what will happen based on all the information currently available. But Ken French says that you can split the asset's return into that expected component, but it's the unexpected return, which is really the surprise, the difference between what actually does happen and what was expected. So he goes on to say, over reasonable investment horizons, 3, 5, 10, even 20 years, realized returns are typically dominated by the unexpected component and inferences from realized returns and often false positives. So that's a little bit of jargon. So he goes on to try and make it a little more easy to understand by drawing an analogy to the FANG stocks and their recent performance. So everybody knows the mega cap FANG stocks. You're talking about Facebook, Amazon, Apple, Netflix, and Google. And so guess what? If you owned them over the decade ending 2021, you made a lot of money. And so from that period, let's say 2012 to 2021, as an example, he illustrates this is the best example to him of the importance of unexpected returns. So let's look at some numbers. 2012 to 2021, average annual return on a valuated portfolio of these 5 large stocks is 30.09%. Wow. So that's 30.09 per year. So the cumulative 10-year return is 1,166%. So wow, you own those 5, you're a genius. Those who use the recent returns on the FANG portfolio, however, to predict its future returns will probably be disappointed, Ken French goes on to say. Well, we all know how things have changed for FANG stocks since the highs of early 2022. The drop has been brutal. The FANG group of stocks were down minus 27% in US dollars as at the end of the year in 2022.
Yeah. Here I'd like to link what Professor Ken French says and what Morgan Housel, author of The Psychology of Money, says in his must-read book. Getting money and keeping money are 2 different skills. Getting money requires taking risk, being optimistic, and putting yourself out there. But keeping money requires the opposite of taking risk. It requires humility and fear that what you've made can be taken away from you just as fast. It requires frugality and an acceptance that at least some of what you've made is attributable to luck, so past success can't be relied upon to repeat it indefinitely. This is another way of explaining what Ken French calls chances dominates realized returns.
Well, again, Morgan Housel in his book goes on to say that he really calls this applying the survival mindset to the real world. For him, this comes down to appreciating three things. And I'm going to quote him. More than I want big returns, I want to be financially unbreakable. Secondly, planning is important, but the most important part of every plan is to plan on the plan not going according to plan. And then the third one is a barbelled personality. So think of a barbell in a gym. Where you're optimistic about the future, he says, but paranoid about what will prevent you from getting to the future is vital. So really what these three things are, I call them integral components of the investor mindset. Don't we keep talking about the long-term investor mindset? So those that's a really, really neat way of framing what it really means to have that mindset. So again, I find this is completely consistent with Ken French's concepts of what he knows about investing. So Morgan Housel goes on to write, if I'm unbreakable, I think I'll get the biggest returns because I'll be able to stick around long enough for compounding to work wonders. And again, we say stay the course, be invested for the long term. It's really about getting that compound return machine working. And it's, 7%, everything doubles in 10 years. Yeah, but what about 20 years out and 40 years out? And that's why in this upcoming book about life skills and investing, we talk to the young generation about the importance of not taking too much risk young, because even if you get average returns, you're going to get a spectacular long-term compounding effect. So don't, chase the oversized returns or make concentrated bets where you're going to dilapidate capital. So again, you want this, as he says, I'm going to repeat it, stick around long enough for compounding to work wonders. So here again, Ken French's concepts connect as the notion of being financially unbreakable simply means that you will reach your goals of lifetime consumption.
Yeah, you said it earlier in the podcast, James. To define risk as uncertainty about lifetime consumption puts the investor in the right mindset of protecting themselves for unforeseen events that will jeopardize their future financial well-being. By thinking about risk holistically, investor will likely make appropriate decisions that lead to better long-term investment outcomes.
So again, now let's look at Morgan Housel's second thing, and it's about having a plan that can adapt to new and unforeseen events and realities. He says a plan is only useful if it can survive reality and a future filled with unknowns. So again, uncertainty about lifetime consumption, really uncertainty. We've talked about this before in the podcast, François. It's something you have to live with and get used to it and accept as normal.
Yep.
So Morgan Housel goes on to say, a good plan doesn't pretend this wasn't true. It embraces it and emphasizes room for error. The more you need specific elements of a plan to be true, the more fragile your financial life becomes.
So planning really amounts to managing for unforeseen outcomes, which said another way is Ken's French concept of accepting the notion that chances dominate realized returns.
Morgan Housel's third thing that he talks about in learning, not only getting wealth but keeping your wealth, is about developing this. He calls it a barbell personality, and I sort of call it tempered optimism. He prefers a definition of optimism as a belief that the odds are in your favor and over time things will balance out to a good outcome, even if what happens in between is filled with misery. So again, he calls this sensible optimism. I guess you might say life happens, right?
Mm-hmm. So developing this barbell personality is tantamount to accepting Ken's French belief that you must be prepared over reasonable investment horizons, like you mentioned, 3, 5, 10, even 20 years, that realized returns will be dominated by the unexpected component. So now let's discuss the fourth concept. Active investing is negative sum game. To make his point, Professor French quotes from a classic paper of William Sharpe, a Nobel Prize laureate in economic science. The paper is entitled The Arithmetic of Active Management. And in this paper, Bill Sharpe makes the case that active management does not work with these two simple assertions. First, before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. And second, that after costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar.
Well, François, like I said earlier, we're all playing in the same sandbox. So together, the passively managed dollars and the actively managed dollars holds the global market portfolio. However, since the cost of actively managed dollars is higher than the cost of passively managed dollars because of higher management fees, transaction costs, and other costs, the performance of active manager as a whole must be lower than passive.
That's exactly it. And that's why year after year, when you look at the data from the Standard & Poor's PIVA report, which details the results of active versus passive, you see that the active managers failed to beat their benchmark index. This historical evidence that shows that passive beats active and the wisdom of William Sharpe are at the root of why we build portfolio with broad-based indexed ETFs.
So in his text, Ken French also addressed the question of why, despite all this evidence, active investing still exists. And he blames it on investor overconfidence. And here's a quote from French in this paper. Given the high volatility of unexpected equity returns, active strategies and managers produce almost as many good monthly or annual returns as bad ones, which allow investors to continue to be confident that these returns, the positive ones, will persist.
Yeah, that's the key, James, for listeners in your last statement from French, was that there are almost as many good monthly returns or annual return as bad ones, inferring that there are more bad ones than good ones. So the fifth now and last concept from Professor French about what he knows about investing is most investors should diversify their portfolio.
Well, yes. So diversification is a classic. We've talked about it a lot, again, in our podcasts, to be broadly diversified. Ken French writes that unless you have exceptional stock picking abilities, and there he goes on to use an analogy of Warren Buffett and Charlie Munger over at Berkshire Hathaway, most investors should diversify their portfolio. For the rest of us, diversification can be a powerful tool. It is important to remember, however, that the goal is not to reduce the volatility of any particular investment. It is to reduce the uncertainty about lifetime consumption. So this last part I find really, really powerful, because when we studied finance, right, diversification was, like he says, was about reducing volatility, finding the non-correlated asset, what goes up when the other one will go down in the offset, and you'll get a more stable compound return, and you'll accumulate more money with that less volatile portfolio over time for many reasons, not just the math, but because you're more likely to stay the course. So that's all wonderful. But here's one of the eminent minds of finance saying, no, it's not about that. It's about the uncertainty about lifetime consumption. So I really think this is very powerful.
Yeah. Well, when it comes to managing risk, diversification is the only free lunch out there.
Well, again, I agree with that completely, François. And we saw that again in 2022, where it wasn't everything in bonds were going down, but there was dispersion. Short bonds did better than long bonds. Value did better than growth last year in a big way. So
Canadian did better than US.
Exactly right. So again, despite this deep need for certainty around our lifetime consumption, we recommend you focus on maintaining a steadfast commitment to controlling risk through broad diversification and a long-term investor mindset for whatever may come in 2023. In our last podcast, number 48, we shared our 6 investment lessons of 2022. Our 5th lesson came from Larry Swedroe, and I'm quoting him: "Smart investors know that investing is about managing risks, not returns."
Great. I think, James, we did a good summary of the 5 things that Professor French knows about investing. As a reminder, there will be a link to the essay of Professor French with the podcast. In conclusion, at PWL, we apply these 5 concepts when designing our clients' portfolios, and we believe every investor should. So thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 49 of Capital Topics. Don't forget, if you'd like to send me questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for next episode to be released on March 16th. See you soon.